Dividend reinvestment, or DRIP, is automatically using your dividend payouts to purchase more shares of the same stock. On Trading 2112, this is called auto reinvest. It allows your investments to grow faster through compounding. Trading 212 supports DRIP for eligible US and certain European stocks. This feature is opt-in and available to verified users with eligible portfolios. As of January 2026, DRIP is available on Trading 212 for US-listed stocks and select European equities, like those on the London Stock Exchange and Euronext. It's integrated into their mobile and web platforms. DRIP is only available for direct stock holdings and not for CFDs or leveraged products. Some volatile stocks, such as penny stocks and markets like Asia Pacific, may be excluded due to regulatory issues. To enable dividend reinvestment on Trading 212, start by logging into your account through the mobile app or web platform. Next, navigate to the Invest or Portfolio section, where you can view your holdings. Select the specific stock you want to enable DRIP for, then toggle the dividend reinvestment option to On. For convenience, you can also enable Auto Reinvest globally under Account Preferences to automatically apply it to all new eligible stock purchases. When a stock you own pays a dividend, Trading 212 automatically uses the cash to buy more shares of that stock at the current market price, typically on the ex-dividend date. Trading 2112 handles this process automatically, so you don't need to manually reinvest your dividends. The reinvestment occurs at the current market price, usually on the ex-dividend date when the dividend is distributed. Fractional shares are supported, meaning even small dividend payouts can be fully reinvested without needing to meet a minimum purchase threshold. The primary benefit of DRIP is accelerated portfolio growth through compounding. When dividends are reinvested, they generate future dividends, creating a snowball effect that builds wealth over time. For example, a $1,000 investment yielding 3% annually could grow to over $1,300 in 10 years with dividend reinvestment, as shown in this comparison table. DRIP also promotes a passive, long-term investment strategy, allowing investors to benefit from compounding without the need for active trading decisions. Market volatility poses a significant risk when using dividend reinvestment. During market downturns, dividends get reinvested into shares at potentially inflated prices, which could lead to buying high. Dividends are subject to taxation as ordinary income, even when automatically reinvested. This tax liability applies regardless of reinvestment, so consulting a tax advisor is essential for understanding your specific situation. Diversification continues to be crucial when using dividend reinvestment plans. Spreading investments across different sectors and asset classes helps mitigate risks associated with individual stock performance. Trading 212's case studies highlight the importance of balancing dividend reinvestment with stop-loss orders. This combination helps protect against significant losses during volatile periods while still benefiting from compounding growth. Trading 212 treats dividend reinvestments as standard trades. Reinvestments are subject to Trading 212's standard commission structure, typically 0.15% for U.S. stocks. Beyond this, there are generally no additional fees for using the DRIP feature. The use of DRIP is expected to increase, driven by automation and AI integration for stock recommendations. There's also a trend towards focusing on ESG stocks with high dividend yields. Future expansions include standardized DRIP features across EU regulations and potential support for Asian markets. By 2030, DRIP may be integrated with robo-advisory services for personalized reinvestment.